So my name is Ben Garber. I work for 7 Mile Advisors. We are a national mid-market investment bank. I lead our healthcare practice as well as the Pittsburgh office. Headquartered in Charlotte, North Carolina. Firm had done a couple deals here in Pittsburgh, including Summa Technologies. The Ed Engler boardroom is named after the founder of Summa. We sold that company, as well as NetServe 365, and most recently brought the buyer for Touchtown, which is a company I actually looked at as a venture investment back in 2011. I feel like the PVCA should give them an award for beating their forecast, like first early stage venture company to beat their forecast. Before that, I came out of running Corp Dev for MedExpress Urgent Care. Ran all M&A up to $400 million. Above that, I typically partner with our parent company, United Healthcare, out of Minneapolis. Also led joint ventures with companies as well as hospital systems, and led our innovation program across Optum and United Healthcare entities. Typically, thanks standing up new products and services. Previously, I had come out of a single-family office private equity firm. I was acquiring and turning around distressed industrial companies. Think Rusty Dusties, real Pittsburgh-type assets. And we also had a minority equity portfolio of technology companies, primarily enterprise software, B2B SaaS type deals, typically come in Series A or B. My role is generally lead the investment, take the board seat, and guide the company to the next round where a larger institutional investor could take our seat. And if things had gone well, at that point, the company had probably outgrown what value I had to offer, and it was time to bring in someone bigger with a broader network and deeper experience. So I've typically opened up this talk by bashing investment bankers for a little bit, but I've now gone over to the dark side. So on the off chance my employer or any of my clients are going to be watching this video, I'll maybe tone that down just a little bit. But generally speaking, the same methods, same tools that we're going to be talking about today are employed by all the investment bankers that you would pay big fees to do the same work. And we're going to talk about how you can do it, or get some motivated undergrads who are looking for a little bit of experience to be able to do it for you. So little show of hands here. How many people here are Tepper students? Okay. How many people are students at Carnegie Mellon but from outside of Tepper? And what program are you in?
Computer engineering.
Electrical and computer.
Saw some hands over there. All right, so engineers from outside of Tepper, and then one startup. Any other startups? Just show of hands. Do you mind giving a couple seconds on what your company is and what stage you're at?
Sure, yeah. So my name is Matthew Borman. I'm a systems engineer in the Robotics Institute. The startup is called Touchwood. We are early stage right now. We're developing a digital display and touch interface for wooden and non-transparent surfaces.
Touchwood Robotics startup.
I'm Ellie Gordon. I'm the founder and CEO of Behavior, and we have developed a system to predict and prevent opioid relapse and overdose using wearables and AI for timely interventions. We're earlier stage. We have a prototype, and then we are looking for funding now to complete development.
Okay. So med tech, early stage opioid treatment. And what was your company's name again?
Behavior. Behavior.
Behavior. All right. Thank you. I saw one more.
Hi guys, I'm Andre Romali. I'm the president of Me and Engineering here. I've been engineering for about a year and a half now, but we're actually going to launch our first product. It's a medical device with a robotic component to predict epileptic seizures.
Okay.
And we're working with local universities for our phase 1 National Science Foundation grant.
All right. Robotic med tech. Very Carnegie Mellon.
And my background's engineering, like everybody else said here.
Right on. Well, as you all know, CEO is also chief fundraiser and chief sales officer. So hopefully what we cover today, you'll be able to, again, bring in interns, bring in other helpers to really open up your bandwidth and allow you to do more highest, best use value work and really concentrate on interacting with the right investors. What we're really talking about today is a marketing and sales process. So we're going to be talking about the sales funnel. It includes prospecting, qualifying, and then outreach and engagement. I kind of ground this back to something I've heard 1,000 times. I'm sure many of you who are involved in startups have heard this as well. Very excited about your company, just not the right fit, not the right time. So what we're going to be talking about today, hopefully you'll hear less of this and more of, yes, you are the right fit and it is the right time. In all sales and prospecting, there's a balance. You need critical volume because even the best companies still are working with a conversion rate. And if you don't have enough volume, a percentage of nothing is still nothing. And then there's quality. So we're also going to focus on finding the right investors, qualifying them for the right match, and that should get your conversion rate up. Still, though, in early stage, you should be thinking of a conversion rate of maybe 3%, 5% if you're doing a good job. So volume's still important. So we'll talk about casting a broad net. And then, again, other piece I'm going to hit on, I hear this all the time. I'm a non-technical student. I'm interested in startups. I want to know how I can help. This is a big way you can help if you're a non-technical employee at a startup. As you know, you're fundraising. The second you close your last round, you're fundraising for the next round. It takes a lot of time, and it distracts away from the operations of the business and hitting your KPIs and growing revenue, which is what attracts the next round of investors. The first resource I'd like to lay out is Mr. Ryan Splenda. Lo and behold, Carnegie Mellon has a dedicated business librarian. This is not something I was aware of when I was a student. He's a fabulous resource. He would like nothing more than to sit down with you and walk through these same databases that we're going to cover, teach you how to use them, help you use them, and then work with you to get the information you need. Ryan's fantastic, eager to help. Please reach out to him. He's here. He's here for this purpose. So the resources that we're going to be walking through are all available to you as students through the Carnegie Mellon Library. Also available to faculty and staff. Unfortunately, not available to alumni. However, the way I've always solved for that is by bringing on talented Carnegie Mellon interns and employees who are current students and still have access to the library. So it's a little value add there. They get some experience, learn how to use the databases, and I get some research. So ones that are available in the Hunt library, and many of these actually now, and this is being a big improvement, are available through the VPN, so you can access them remotely. And I kind of divide these databases into two sets, ones that go broad and ones that go deep. Thompson 1 and S&P Cap IQ go deep, although are not always the best user interfaces. The other ones go pretty broad, and when you're creating a sales funnel, I always like to start broad. Again, volume's critically important. Ones that are available outside of the Hunt library, just to anyone. AngelList is always good for doing personal research, so checking in on an individual investor. Crunchbase, as the platform's kind of matured and they've monetized the information they have, it's become less accessible, little less easy to use. But if you're actively engaged in a fundraising process or you're preparing for one, I'd encourage you to buy the 30-day trial. It's pretty cheap. You can cancel after a month. And if you're focused on it, you can get most of what you need out of it, in 30 days. We'll also touch on some SEC filings. Great resource to identify individual investors, as well as investors not necessarily connected to a fund, often listed in SEC Reg D filings as directors. So other good resource. The Pittsburgh Business Times is also available to students, and they publish a book of lists. Again, great resource just for starting the process. So also access that through the library. All in all, these are hundreds of thousands of dollars of databases that you are paying for as part of your tuition. So I'd encourage you to use them. When I've tried to quote these to purchase them after I no longer had access to the library, generally, I'll say S&P Cap IQ's going to cost even a small firm over $50K. Same goes for Privco. Thompson might be $100K. So you have some great resources here. They're the same resources that the professionals use. So take advantage of them. The case study we're going to be talking about today is Trust Lingerie, Carnegie Mellon startup. Sophia Berman, excellent founder, fantastic person. An interesting company, solving an engineering problem. They create bras the way engineers build bridges for maximum support. Little update on Trust. The company took in some new funding last year, and they've moved to a larger headquarters and showroom. They've also expanded the staff and their biz dev operations, and have brought on some male employees as well. So experiencing some strong growth in great group of people. Some quotes just to give you a little feel for the company that we're dealing with here. Very passionate customers. Sophia's top left here. One point I'm going to touch on around network. So investors like to invest with investors they've invested with before, or investors who know their buddies. So you do get into some closed networks here. It's very insular, and that can make it hard to break into. And the same goes for operators. So Bill Besselman has recently taken over as CEO of the company. He came through and was introduced by Draper Triangle Ventures. Bill was COO of one of their portfolio companies. So private equity firms, venture firms, always looking for talented business professionals to help run their companies. And it's no knock to the founders or the existing team. Oftentimes, if you see a founder who's maybe moved over into a chief technology role, a transition like this may have happened. Speaking from the investor standpoint, it's one skill set for a CEO to take a company from 0 to 10 million in revenue. Start from scratch, maybe just an idea on a napkin, and really form a business out of it, and get some real traction and momentum. It's another skill set to go from 10 million to 50 million. You're now increasing the number of employees, the administrative function becomes bigger. And then another skill set entirely to go from 50 to 250 or 500. So oftentimes a founder or an early stage CEO, as the administrative burden of the growing company increases, they might say, hey, I'm passionate about product, I'm passionate about the customers and solving these market problems. Administering a large team of employees is not as exciting for me, and may not necessarily match up with my skill sets. And that's often sometimes when you'll see an operator recommended in by an investor like Bill. So again, key steps, we're going to be talking about prospecting, qualifying, and making contact. First step here is identifying comparable companies. You have to start somewhere. There's a gazillion companies and 100 million investors, so where do you start? Comparable companies is the best place. And then we'll talk about how you qualify, what constitutes a good fit, as well as how do you go about making contact when these people aren't in your network, and what materials should you have prepared. Before we move on, any other questions, anything else that someone wants to make sure I hit on, or anyone in a unique position that maybe I can weave in with some examples? All right, we'll get rolling. So what makes a comparable company? Again, I'd encourage you to think broadly. This whole process starts with a little self-reflection. What type of company am I? Where am I in my life cycle? And what am I looking for? Who are the customers I'm serving? What markets do I play in? It's very easy to think of every startup as a snowflake. And yes, everyone's solving unique problems in a unique way. But investors generally have to think in broader terms, and experience is applicable in a variety of situations. So generally speaking, the way investors will think about comparable companies and the way you can think about investors to see if they're a good match is industry. Again, think broadly. Trust is making lingerie, but generally think clothing, fashion, consumer goods even. If you want to broaden the scope a little bit, maybe focus on consumer goods that sell to women. But that's going to greatly expand the pool of comparable companies that you can target. Again, target market. Are you targeting female consumers, manufacturers, retailers, health systems versus payers versus pharma companies? So who are you selling to? Who are you creating value for? Company stage, pre-revenue, pre-earnings, or are you a growth company? Most investors typically, stick to certain tranches. Some invest across multiple tranches. Some invest across multiple funds, which can sometimes be irritating for their LPs. It's a way to kind of save the prior fund's returns on the back of the future fund. Unless they set up dedicated funds to do that. Oftentimes the larger firms will have a seed stage fund and then a growth stage fund. And the one feeds into the other. Incline Equity actually just set up a new earlier stage buyout fund for the lower middle market companies that as their fund has grown, the mechanics of investing out of a larger fund has prevented them from acquiring these smaller companies that they used to make great returns on. Investment size typically pairs up with stage, but also with fund size. There's only so much capacity in a fund, and they also need a certain amount of diversification. A good, venture fund will have a minimum of 20 companies across their fund. So you also need to think how big is their fund, divide that by 20 portfolio companies. And then also, it's pretty common, best practice for an investor to reserve 3 times their initial check for follow-on investments. One, to continue to support the growth of the company, but also to preserve their pro rata equity stake in the company. So take fund size, divide it by 20, then divide it by 3. You're approximating what the initial check size might be. So you have to match that up with what you're looking for. And then also geography, less and less an issue, but it still matters. Face-to-face meetings, checking in on the company still matters. A lot of us live on airplanes, but often you'll kind of see investors either stick to the East Coast or stick to the West Coast. And even the national firms will have satellite offices, and that's how they provide national coverage. So these are the criteria you should be thinking about. As we're profiling investors, I'd encourage you to at least be entering this information into a spreadsheet. So think about having all the individual investors and their firms listed out, and then all these attributes in the columns. More so, I'd encourage you to use a CRM system. If you're not using one now, you're going to use one later, and it's the type of exercise that the longer you wait, the more burdensome it becomes. You don't need Salesforce. There's a gazillion CRMs out there, but this is the same type of information you'll be entering to prospect customers. Investors are just another type of customer. You're selling them your equity, you're selling them your company, possibly a debt instrument, so future earnings. It's just another type of customer, and this is still a sales process. So profile your own company in these terms, so that you know who you are and what would constitute a fit from an investor's perspective. Again, cast a broad net.
On your previous slide, that information, yep, that one. Is for that type of snapshot, so in Google to see what
Hmm.
you're looking for, or
I
you
think-
just call it comparables?
So comparables, what you'll find are typically either transaction sets or landscapes, which will show, a bunch of different logos for each given industry, maybe broken out by stage. This I would call a corporate profile. The other word that you could look for on this is tear sheets. So this is usually profiled in a tear sheet, TEARSHEET. SAP Cap IQ actually uses that term, and they have a tear sheet for every single company. I think CBE Insights also produces tear sheets. So that might be the word I'd look for, tear sheets or profiles. So where do you start? So again, we'll hit on comparable companies in a moment. This is a new resource. So CB Insights now offers these subsector industry reports. They're pretty nifty, and they get kind of esoteric. I had never heard of poop tech, but it's big enough that CB's covering it. Chances are, if you're able to think broadly enough about the industry you're playing in, they'll have something for you. And they put together these great industry landscapes, like we were just talking about, and that'll give you a lot of companies to start with. So we're then going to take these companies and look at who invested in them and who co-invested with those investors. This is not difficult work. It's another reason why it is a good match for, I'd say, interns, current undergrad students, MBA students. It takes a lot of time. I mean, if you've ever gone down a Wikipedia wormhole, that's essentially what we're doing here. You're just then taking your wormhole and entering it into a CRM or into a spreadsheet. But that's what we're doing with these databases. So not difficult. It just takes a little bit of logic, critical thinking, and then time. But a massive help for any startup. And usually it's something that falls on the CEO. So again, non-technical employees, how can you help? Putting in the time on these exercises. Trust is actually profiled on here, which I thought was pretty exciting to see. They're included. There we go. Yeah. And then I think if you dig deeper in, they're listed as a disruptor, which is fun to see. Other cool new feature that's available that didn't used to be. So CB Insights will let you search for all investors who are active in that subsector. You can then also add the investor and see how many investments they've made in that subsector. Again, these are databases. They're not perfect. A little thing I'll call out here. You'll see with Upfront Ventures, they're listing 4 fashion investments once you do the cross-reference. If we jump back, I don't think they're on here, but in other areas, they're listed as having, yeah, here we go, 7. So 7 here, 4 here. These databases aren't perfect. That's why I encourage you to use multiples. They generally overlap in their data sources, so you'll find a lot of the same information, but it's not 100%. So, cross-check and double-check your references. But again, great way to identify investors who are in your sector. A question I get a lot, if an investor has a comparable portfolio company that's very similar, how likely are they to invest in me? And it's a function of how active that investor is. Someone who's making high volumes of investments like an Innovation Works or a New Enterprise Associates, they're much more company agnostic as far as competitive dynamics because they're placing so many bets. A smaller fund who maybe only has 4 fashion investments likely will not make 2 lingerie investments that are both targeting plus-size women. Now, they will make adjacent investments. So if they have a women's fashion brand that isn't covering the lingerie segment, that's actually a pretty good fit because they're going to leverage the institutional knowledge they've built through the other portfolio company. But how comparable is too comparable? is a function of how active that investor is. CB has a profile page for trust, so that was good to see. Two investors listed, one's InnovationWorks, one's Break Trail Ventures out of Denver. So we'd then take a look at Break Trail Ventures, say, hey, who are these guys? What are they invested in? I haven't updated their profile recently, but you can see that they're pretty active. So that would tell me, they're worth looking at. And then, again, investors like to co-invest with people they've invested before. And they generally line up on what they're looking for, what values they prioritize, what metrics they look at. So if Break Trail's not the right match for whatever reason, maybe it's too late in their fund. Something to be aware of is a lot of venture funds and a lot of investors will stay out in the market even when they're running out of dry powder because they have to keep their pipeline full while they're fundraising. You want to make sure that the fund, not just the firm or the investor, but the fund, the pool of money that they're making the investment out of, has enough cash left in it that they'll be able to support you through your next funding cycles. So that's the 3 times dry powder reserve capital I was talking about before. Oftentimes when I see funny deals that don't totally make sense, it's because the prior investor had reached the end of their fund life. So that's another thing you want to look for. Are they in year 8 of a fund? Not as attractive as someone who just raised some fresh money. Or the existing portfolio isn't driving the way they had hoped. They have leftover dry powder, but maybe not enough reserve capital. So things to watch out for, even though investors are out in the market saying they're doing new deals. Great thing here, though, it lists their co-investors. So if Break Trail is a warm fit, but maybe not best, also good to see who they're co-investing with. Harlem Capital is on here. Break Trail's in Columbus and Boulder. Taking a little jump here, now linking CB over to the SEC filing. Interesting thing I found out only by digging in. Trust is actually called Bazooka Jane, which I think is a fun name. That's their actual corporate name. And then it'll also tell you how much money they were raising, how much is already closed, and where the money came from. So it's not just enough to know that Break Trail invested. You actually need to know who at Break Trail invested. Because individual investors do deals. Funds don't do deals. A fund's just an investment vehicle. Firms don't make deals. Partners make deals. So you need to know who led the deal because ultimately they're going to be the decision maker at the end of the day, and that's who individually you have to reach out to. So by going into the SEC filings, the tool is called Edgar, like the name, EDGAR.
Real quick, like super basic level, could you explain like firm, investor, fund, like from a 50,000?
Yeah, totally. So the question was just to kind of outline the difference between a firm, a fund, and the individual investor. So the firm is a company that goes out to limited partners. Limited partners are endowments, insurance companies, universities, who then invest in private equity or venture capital funds. Now, a fund is a discrete pool of money. So actually, right here, we'll see that Break Trail did a fundraise for Break Trail Fund 1, limited partners, of $20 million. And a firm, so that company might have multiple funds. This pool of $20 million is raised with a mandate. They'll be saying, we invest in early stage technology companies, possibly in these sectors. And the LPs who gave them that $20 million expect them to honor that mandate. There's then partners who are employed by the firm, but will own part of the fund, which is managed. So the firm is the general partner, and they take a fee to manage this $20 million. The people who are actually doing the management are the partners. They should have a piece of it, keep incentives aligned. But that's the general breakout: firm to fund to partner. Other thing I'll call out, just while we're on the topic, is mandate drift. So much to the chagrin of LPs, managers often kind of drift outside of that mandate. So again, it's in everyone's best interest to stay focused on what that $20 million is supposed to be used for. My two favorite examples I used, saw a health care and med tech venture company invested in POGs, like the cardboard milk caps. That was a brain scratcher for me. I'm an LP for an endowment, and Point Judith Ventures out of Rhode Island, another technology VC. I was interviewing them, to invest in one of their funds, and I was digging through, these same databases, and I saw one of their first investments was in Narragansett Brewing. Nothing AI about that, So I asked, I said, what the deal was. They said, we were just getting started and still figuring it out. So at least they were honest about it. But at the end of the day, what you're looking at is this fund amount and when it was raised. They typically want to deploy all their capital, I'd say, in the first 6 years. That way you still have 4 to 5 years, for the companies to grow and then sell. And again, we kind of talked about the mechanics of going from the size of the fund down to individual check size. So that's what you should be focused on. And again, it's the partners who are employed by the firm who make the investments.
So for that fund that was raised in 2018, they haven't made all the investments to see these are how many portfolio companies. How much would you estimate that they would use per investment?
Yeah, so that...
If there isn't a number to divide that by.
There's standard best practices. So again, that fund, to have adequate diversification, should really be invested in at least 20 companies. 20 is kind of a benchmark here. It's hard to be an active investor with too many more than that because each of the partners has responsibility for a certain number of portfolio companies. And at that point, you just get into human capacity. How many companies can one partner reasonably oversee? If you go to a mega fund and each partner has responsibility for dozens of companies, you as a company seeking their investment should not expect a very hands-on investor who's actually going to get down into the weeds with you and create a lot of value there. They're more deploying capital. Did that answer your question?
Kind of. I've heard 1% of fund size for proper, I guess it depends on however you do the math, right? You figure whatever the percentage is or the amount, you can do a formula and then that times 3 equals fund size. So I guess you could come up with what that missing variable is.
Mm-hmm.
I was just curious if you had any perspective on newly raised funds, how much, what their investment size.
Yeah, I would typically go fund divided by 20 for what they'll deploy over the life of that company.
Okay.
And then take that divided by 3 for what the first check size would be.
Got it. Okay.
That's the heuristic I use. So Harlem Capital, a co-investor with Brick Trail and Ant Flow. So you'd pull up each one of these and you start profiling them. And then, again, you look for the name of the actual investor who led the deal.
Quick question. Would it be okay to ask an investor where they are in their life cycle of the fund?
Absolutely. So the question was, can you ask an investor where they are in the life cycle? I would encourage you to ask that question. That's completely appropriate. They shouldn't be shy about answering it.
How many companies they've already invested in? Because that would, sometimes they take meetings just to know what the companies are doing.
Yeah, totally. So most investors will publicize the companies they've invested in on their website. If you have an investor who's opaque about the companies they've invested in, I'm not saying it's like a don't work with these people red flag, but that means you are an a little gray territory. Often family offices will operate this way. It doesn't make it easy on their staff to go generate deal flow. Really, you want to be out in the market screaming at the top of your lungs, this is what I invest in, these are the companies I've invested in, and look at them, they're such great companies, they're going to be so successful. So if you are talking with an investor that doesn't promote their portfolio companies, I would just take it as a word of caution. You're probably not working with someone who plays by traditional professional administration rules. And again, that doesn't mean they're a bad partner. You're just maybe veering off path in a little bit of a gray area. And then absolutely it'd be appropriate to ask, how many companies are you already invested in? What's the life cycle? And how much is left in the fund? So all totally appropriate questions. So again, find the partner, find the co-investors. So really what we're doing here is we're creating a web. So this is when you're really going down the Wikipedia rabbit hole. So you'll start either at CB or your comparable companies. You'll find their investors. You'll find their investors' co-investors. You'll find those investors' co-investors, and you start profiling them. Again, use the fund size, number of portfolio companies, i.e. how active they are, and then the different stages that we talked about for differentiating, industry, check size, stage, geography. So put those all in your CRM or in your spreadsheet to track these. Most investors, again, professional funds who are raising money from outside LPs, who are incentivized to get deals done. That's how they get paid. So usually the way these investors make their money, it's a combination of a fee just to manage that pool of money. But they make their real money when they sell the companies and generate a return for their LPs. So they don't get paid unless they make investments and then sell them. So that's why they're incentivized to get out there in the market and generate deal flow. So to facilitate that, most investors will list their investment criteria on their website. Absolutely, please take the step of reading these. When you're doing outreach, the best, short of a warm introduction from a mutual connection, the best and also minimum reason that you should be reaching out to someone is saying, hey, we match your investment criteria. So take that extra step to do that bit of qualification. Just blasting your information to every investor that you can find is not going to be a productive use of your time. And at worst, you could develop a reputation around it. So read their investment requirements, and I would link to this in their profile in your spreadsheet so you can go back to it and look it up easily. Because you're going to want to reference it when you reach out to them.
I have a question. So you're saying this is almost very sophisticated cold calling, right?
This is absolutely sophisticated cold calling.
But
Now,
what I've heard, they're saying, well, don't even bother with that. You gotta go to these people and then have them at least introduce you.
absolutely. So there's a hierarchy
Yeah.
on getting these introductions. And absolute best is a warm introduction from a mutual connection, or even not a mutual connection. It could be a second removed. I mean, you're finding people on LinkedIn and saying, hey, CMU friend, I see you know someone who knows someone. Can I get an intro? An intro from another investor who they've co-invested with in the past is top. They already have that relationship. They trust each other. They know that they look at things in a similar way. Below that is just a mutual connection. But if you don't have that network already, like, how else are you going to reach these people? And at the end of the day, if you're able to present yourself properly, and we'll talk about that, and you have the right information, you should have a higher than average hit rate because you're targeting the right people and you're saying the right things. But absolutely, this is a little bit of cold calling and cold outreach. One reason people hire investment bankers is, and I'm not saying it's this is necessarily worth it, but this is what we do professionally. So when we cold reach out to someone, they know it's probably already a pre-qualified deal, and it's worth their time to look at it. It also means that people are serious about the fundraise, and they're organized.
One more question. So I contacted a firm, they said, hey, if you pay us $15,000, we'll take you from beginning to end, meaning we'll hear your story, draft you the financials, the pitch deck, coach you, and then we'll give you 100 companies that they are investing in your type of group. Do you think it's a legitimate company?
Yeah.
Do you think it's worth $15,000?
So paying someone $15,000 to prepare your materials and then give you a list of leads.
Financial model, they work with me. It's almost like going to school for 2 months with them.
So is that worth $15,000? I would ask them their track record on converting those leads into investors. So that's what's going to decide if it's worth it. I mean, paying $15,000 in order to raise a couple $1 million, totally worth it. I'll say, do not worry about the $15,000. That's a transaction expense. If you're raising a couple $1 million, cost of doing business, and if it speeds up the process, leads to a smooth process, and lets you focus on what you're doing, which is running your company, $15,000 would be well worth it. Our minimum fee is $750K, and we don't work on capital raises under 15 million. Try not to work on ones under 20. 15K if it's effective and they have a track record of converting, totally worth it. If you don't have 15K, to pay a firm, get some interns and we'll do the same thing. Yeah. And you'll see in the investment criteria all the same things that we talked about as far as breaking up by sector and stage and check size. S&P Cap IQ is one of the deep resources. This is definitely one that you'd want to follow up with Ryan Splenda on so that you can learn how to use it and get a little tutorial on it. Not very easy to use. Great info. I use this every single day. But again, not easy to use. So it just takes a little bit of time to get used to it. User interface hasn't changed I've been using it for 10 years and it hasn't changed. So they must be in a pretty comfortable position. But the screening tool is where you'll start out. They have a great tool called Find Investors. So probably a good place to start. Also in screening, over here in the left column, you'll see transactions. So one thing we'll touch on, the financing people in the room may have heard of a comp set for a private company M&A valuation. Same process for building comp sets. You go to the same database, you look at the same transactions, identify the same investors. It'll just list how big the deal was, and sometimes you'll get a revenue multiple, an EBITDA multiple, and that'll help you kind of figure out what your company should be worth when you go into these negotiations. Absolutely encourage you to go through this, even if you're already talking with investors. They will have this information, so it is not a level playing field. It also helps you call out BS when you see it. Companies will either put low valuation companies on their comp table to tell you that you're worth less than you are. And on the flip side, as an investor, bankers and entrepreneurs and other investors will often put abnormally high valuations on their comp tables to say, we're worth so much more. Health Catalyst IPO'd on everyone's comp table. When LinkedIn IPO'd, I couldn't tell you how many companies I saw LinkedIn on their comp table. Like, I'd get lingerie companies with LinkedIn on their comp table. Like, you are not a comparable company. So this is the same tools that you'll use to kind of prepare to go into those valuation conversations. You narrow down your comparable companies by industry. They have a whole long list of smaller and smaller and smaller criteria. Again, we are building a sales funnel here. So start wide. It's a bit of an iterative process. So the first time you go in, you're probably gonna start kind of narrow. You're not gonna mean to do it. You're gonna be like really focused on just exactly what you are, and maybe it spits out 50 companies. that's not going to be enough. 50 companies might lead you to 150 investors. If you're lucky, it probably actually gets narrowed down. So usually when I'm going through this exercise, it's iterative, and I'll bucket my results into 3 baskets. One is most comparable. Like, these are great comps. These investors are a great fit. But maybe I didn't get enough of them. Maybe you only got 25, maybe you got 50. And then I'll have a basket of mediums. It's a pretty okay fit. It's still reasonable to reach out to these people. You have a reason. You say, hey, I met your criteria, or you have an adjacent portfolio company, or you co-invested with someone else and they invest in companies like me. When you're doing that outreach, you want to have some reason why you're reaching out other than that you're raising money, why you think it's a good fit. So, I'll have a medium bucket, and then usually I'll end up with a stretch bucket at the bottom where maybe you're getting a little tenuous. It's still in the right universe, but not as good as the first 2. You'll want to have those companies in your reserve basket. You'll find them as you're going through this exercise anyways, and you're going to see companies and investors where you say, they're not the best fit, but I don't want to throw them away. So I put them in that bottom bucket. You want to look at the stage that they invest in and make sure you're looking at something like growth capital instead of a buyout. So this screen, you can see I ended up, I started with a population of 326,000 companies and narrowed it down to 149 transactions. So that's like the extent of this funnel narrowing process. And that's why it's a little bit iterative. Down at the bottom, you see it lists out the companies, the transaction date, and then all the investors who came in on it. Again, this is back to your Wikipedia wormhole, building out the web here. So you're then going to want to look at each one of those investors. It will have when they raised their fund, how big the fund was, who the partners in the fund are, and then who they co-invested with on each one of their deals. So you're now building out this network. This is why it kind of comes back. A CRM is made for this, but you can absolutely do it in a spreadsheet. This is an albeit old but exemplary comp table. So this is what you're going to end up with after you go through that. A question I often get is, how do I prioritize who I reach out to? So beyond best fit, so figuring we've already made our 3 buckets, best fit, medium, and stretch. When deals are announced, usually there's a memo that goes out on PRN Newswire, or it'll go up on their website, or it'll end up in the newspaper, but there's a deal announcement. The lead investor is who will have a blurb in that deal announcement. It'll say, so-and-so Ventures invested in XYZ company, and then there'll be a quote from the investor saying, we're so excited to help this company succeed. That's the lead. The follow-on investors who participated in the syndicate are not typically quoted, and oftentimes in the S&P database here, it'll say who the lead was. So when you're doing your outreach, you might be putting together a syndicate. It's something, another thing people hear a lot is, I'd love to invest once someone else writes a check. I've worked with companies who had a dozen of those, and they're just waiting for someone to finally write that first check. That's your lead.
I have a question. So some investors have told me that if you can get an SBIR grant from the government, that's almost equivalent to getting investors. Like, that's very valuable to people.
Yep.
Is that something that's similar to your
So SBIR grants are attractive because they're non-dilutive. So an investor would be telling you that because let's say your capital requirement, so how much money you need, and by the way, however money you think you need, double it. Sincerely, you might want to triple it, but at least double it. They're looking at that and they're thinking about how much dry powder they have, what their syndicate looks like, and what their typical check size is. And they might be thinking, man, this guy's going to run out of money before he's gotten enough traction to have good metrics for us to go raise another round. This is what I used to do all the time. Again, you're trying to bring in a larger investor to then take the lead on the next round. So they're looking at that thinking, I would be more comfortable if this company had a larger cash cushion. What you're not going to get out of an SBIR or a Department of Energy grant or any other source of non-dilutive funding is the network and reputation per se that comes with having a lead investor, and that is partly what you're looking for. My firm raises capital from a variety of investors across tranches, so of all stages, sizes, as well as debt investors that come in different types of vehicles, as well as these SBIR hybrid funds, which more and more actually are true equity investors. So these are government programs administered by private firms to give lower interest debt to companies to fuel economic growth. And they used to say, we equity co-invest to make sure we're aligned with our companies. And that used to mean like 2 or 3% would be equity compared to the debt amount, which I think is mostly for marketing purposes. Now those same funds, over the years, they've gotten much more active and much more aggressive. Tecum Capital here in town, which spun out of First National Bank, is an SBIR with an equity fund. And they, I think they go up to 30%, maybe 40% equity. And that's what I'm seeing across that whole market. So we work with those funds often as well. And if they're...
SBIC?
Oh, SBIC, sorry. Yeah. Thank you. Crowd participation. Appreciate it. Keep me honest. With those funds, because they are administered by a private firm, they have the same structure. You will have a partner who has a network who's working with you to make sure you hit the mark and that they can then trade on to another firm.
Do these screening services cover corporate venture as well as private venture funds?
They do. So the question was, do these cover corporate venture? They do. And you would treat corporate venture the exact same way as you would treat a professional independent venture firm. Only twist there is often there's some mandate or requirement that it has to be strategically applicable to the company. And some firms are fantastic and have even given up making equity investments. They do what's called their venture customers. So BMW, for example, shut down their venture fund, and they make investments by becoming a strategic customer in early stage startups, and they dedicate internal resources to helping that customer, that vendor, really develop as a strategic vendor. That's a competitive differentiator for them, but they don't take any equity out of it. That's usually a requirement. UPMC, their enterprises group, will not invest in a company unless UPMC, the health system, or the insurance group can be a customer. Optum and United were the same way. The best ones will vet you through the company first. Less good ones, the venture guys and gals will make investments and then bring you over to the company and try and shoehorn you in. It doesn't typically work out so well. But corporate venture absolutely falls in these buckets. It just typically has a higher threshold for strategic value. So again, you have all these transactions, what stage they were, how big the size was. If you're raising 1 to 3 million, you maybe don't want to go to Mercado or Norwest. Again, it's going to be a function of fund size. And it doesn't necessarily always go the other way around. So if you're raising a large round, do you want to cut out the people at the bottom? Not necessarily. Oftentimes funds, I used to do this, even though we focused on A, B, C, I would make seed investments, little tiny ones, just to, one, get my foot in the door and kind of preserve that relationship so I have the opportunity to participate in the follow-on rounds. But also, I mean, you put 50K in a company, you buy a year to get to know them better and see if they do what they say they're going to do. And if that saves you from making a bad $1 million investment, that's probably 50K well spent. So I'm going to look at upfront ventures down there a little later on, but doesn't always go top down. But if people are making $35 million bets and you're trying to raise 2 or 3, it's not going to be a good fit. So it does work bottom up. Market line database I absolutely love. Terrible search function. So again, very broad. It doesn't allow you to do or ands type qualifications. So you have to pick your keyword and you end up with pretty broad bucket. But it combines with Crunchbase pretty well. So if you can kind of match Crunchbase and MarketLine together, that'll give you the same level of information you're looking for. Adore Me, portfolio company of Upfront Ventures, co-invested with Moose. Moose, so again, kind of getting back to the network here and how you make these connections. So Moose is the family office of the Chanel family. They are invested in 4Moms here in Pittsburgh, Robotic Baby Products. Dave Mulwiney and I are also invested in 4Moms. So if you needed to get to Moose, you could go to someone at 4Moms or Dave. And you know, that's a kind of roundabout way, but that's how it works. So that's why you have to look at the co-investors and their portfolio companies, and then that portfolio company's investors. You kind of find your pathway. So we're looking at Adore Me, another lingerie company that took venture funding. Looking at who they've raised money from, what rounds they came in on. This is their tear sheet from MarketLine. Again, other funny things you find. They used to be called webcam generation. I guess that was back when like webcams were cool. I just found that personally funny, so I highlighted it. So we're saying, all right, well, we're a lingerie company. These guys invested in a lingerie company. Different. I mean, you'll see in a minute. They're going after different market segments. So adjacent, but highly comparable. So they might be appropriate to reach out to. But again, you need to find the partner. Highly active. 208 investments across 129 companies. That gives you an inkling of, are they reserving follow-on capital? So they're participating in multiple rounds. $1.2 billion, that says funds raised. I don't know if that would be a single fund. I doubt it. That's probably in total. So you go to the venture fund's website. Again, they should be promoting their portfolio companies and related investments, but also what should be on here is it will have the partner who led the investment. So now you know the person that you have to reach out to.
I just emailed it. Is that what you're saying?
Yeah, but we're
very crafted.
Well, we're going to get to the materials that you want in a minute. Trust lists Adore Me as a competitor, so this is just another reality check. Did we go down the right rabbit hole? So now, making contact. How do you do that, and what materials do you want to have to make sure that you get that conversion rate up? So again, introductions are absolutely the best way. Use LinkedIn, use your professional network, use your friends. But if you don't have the network, how do you reach out and make contact in a way where people might respond? So there is a hierarchy, co-investors and then other investors just in general. So even if they haven't co-invested, there is something to say that these people operate in the same business, they look at things the same way. If you talk to an investor and they tell you that you're a fantastic company, it's just not the right fit right now, there is a reality check you can put on that, and that's to ask for 2 introductions. If they mean it, if they think that you're a good company, they should provide you with 2 introductions, and I encourage you not to leave any meeting ever without asking for 2 introductions. That's one way that firms repay each other, is by sending each other good leads. If they're just saying it and they don't mean it, you're not going to get those introductions. But if they mean it, you should be able to get 2 introductions out of them, either to co-investors or other investors that they know are active in that space, because they have a network. It's what they do professionally. If you have existing investors, this is what they should be bringing to the table. The number one, I mean, even ahead of strategic advice and counsel, job of a board member is to help you raise money. So if your board members are out of money on their own, I don't know how much longer they should be on your board. And if they're not helping bring in money for the next round, they're not pulling their weight. That's what board members do. Yeah, we attend board meetings and, get cranky about cash flows. But number one is helping to raise the next round. And if your board members aren't helping with that, they're not carrying their weight. Industry leaders also, absolutely great source of introductions within their industry. Again, these are people who get tapped all the time by these firms to be operators of these companies. And they're seen by investors as people who can vet for quality, product market fit, and generally tell, again, it's a pre-screening tool. Is there something here? So if an industry veteran that you can get to through your network can make the introduction, that helps. And then we're down to cold callers and investment bankers, which are often doing cold calls as well.
Do you think it's good to go top down and bottom up? Go all direction, or do you?
So how do you prioritize this, and should you go at it from both directions? That depends on how much time you have on your hands. And I would encourage you to always focus on highest and best use of time, and I'd go top down. The bottom up stuff, again, that's something that interns and new employees can help with. You'll want to actually do the outreach, but they should get everything set up for you. Many investment bankers are just casting broad nets and doing cold calling. They're hiring the same interns and undergrads that you could be taking on to do it and charging big fees. The best ones, what they bring to the table are actual relationships. So when they call, people pick up the phone, they know each other, there's some rapport there. But many of them are just going through this exact same process with the same people doing the same stuff. So when you reach out, you want to be prepared. So have your contact list already built out. Have the reason why you're reaching out, which is you have an adjacent portfolio company, you invested with someone else who's in the space, you play on the same themes, I meet your criteria. Hit that right up front. That's the very first thought they're going to be thinking. Nothing irritates these people more than someone who reaches out and you say, did you even look at our website? Like, it's right on the website. I only invest in Series D, and you're looking for a Series Seed. So hit that right off the top. A one-page summary. People call it a teaser. It should convey just enough about your company that should tell them, hey, this is your growth trajectory, this is what you're focused on, this is what you're raising the money for, use of funds, so why do you need the money? This thing is going to get passed around everywhere under the sun, so don't put anything on your summary or your teaser that you wouldn't be comfortable if it was posted on the internet. That likely won't happen, but it's like one small step away from just being broadly available on the internet. It gets passed around. And there's no non-disclosure agreements involved in any of this, especially with venture firms. Private equity firms, when you're focused on a larger buyout, sign NDAs. Venture firms look at so many deals. If you ask for an NDA, they're going to pass before even looking at you. So again, up front, you're providing just enough information to give them an idea of how big you are, what your focus is, use of funds, what your product is, but you better be comfortable that that's going to get passed around. If they respond and say, yeah, I read through the materials you sent and I'm interested in learning more, I would typically then go into a phone call, because now you're going to start vetting them. Someone mentioned investors taking meetings just to learn, exploratory meetings. I've been through many of those myself. They're frustrating and it's bad form. If they respond to your initial outreach and say, yeah, we're interested in learning more, I would typically then go to a phone call where you can ask them questions about why they're interested. So if they are interested, if that phone call goes well and you're ready to move forward, you want to have your pitch deck already prepared. Under 20 slides. There's many pitch decks available online. I'd follow the best practices. But if you have someone on the hook, a smooth process is a fast process. So the more times you have to wait to pull your materials together, things are going to slow down. People get deal fatigue. They get distracted. So try to have all your materials prepared up front. So you have your summary. You'll have your pitch deck. And then if they review the pitch deck and they're still interested, you're then moving into territory of possibly an in-person meeting, and they're going to want to review your business plan. Business plans take all sorts of different forms. All depends on your company and what stage you're at. But again, have your materials already prepared. And then any, I'd say corporate documents, financials, IP, have that set to the side. Because if they read the business plan and they're still interested and they want to move, again, a smooth process is a fast process. So, again, kind of covered casting a broad net. Where do you even start? So again, comparable companies, what qualifies a comparable company? Industry landscapes, define comparable companies and their investors and their co-investors. Qualifying, what makes an appropriate investor? Are they the right stage? Are they the right sector? Are they active? Is the fund new enough? What's too comparable? Are you adjacent? What's their investment volume? And then the materials that you need for outreach and how you kind of prioritize how going about it. So with that, I'd like to open it up for any questions, any specific use cases, or if anyone's in active dialogues. But again, reach out to Ryan Splenda. He'll sit down with you at the terminal. Frankly, help do a bunch of this work for you, because that's what librarians do. I didn't know that as a student. They're an incredible resource, so please reach out to Ryan Splenda. These are amazing resources at your hands, so use them while you have them. Any questions pertaining to activities that people are involved in, or if you're interested in doing this type of work? One, I'd encourage you to match up with one of the Swartz Center companies. They're all going to need this. There is a distinct gap in funding, at least in the region, between seed to Series A. So we have a lot of companies who have raised seed money, which isn't always quite enough to get you to where you need to be for a highly competitive Series A. So there's this trough, and this exercise can really help bridge that trough or bring in the right investors that you will make it over. And every one of CMU startups is going to need this type of work. And it's a great way to get experience and build your own personal network while you're at it. So great opportunity for both non-technical students and technical students who are trying to get a little more exposure on the investment side.
I have a quick question. So I'm at that.
In the trough?
Do you think it's possible, let's say I do this and it looks kick butt, right? And it looks very good and it's sound. Do you think I can jump from a pre-seed to a seed? Or I wouldn't even say VC because I think it's just VCs
Mm-hmm.
want traction, right? They want revenues.
Yeah, so even, especially in the SEC filings, you'll find the seed or angel investors often listed as directors. Usually the leads and the most significant investors, the smaller ones who participate in a syndicate are usually listed as, chose not to disclose. But the directors are taking a board seat and they're listed on those filings. I use that, we have buy-side clients who hire us to go acquire companies for them. And I use that tool to often get into kind of these really early stage companies and find my way into those connections. If you find an investor who's the right fit, but you're too early, there are some mechanisms to help you make that jump. Either they'll make a smaller investment than they typically do, like my seed investments, or you'll be looking at a convertible note, which is often a tool investors use when it's too early to put a firm valuation on something, and they're not quite ready to write a full equity check or maybe provide their full participation. So convertible notes are a great tool for bridging in really early stage companies.
Okay, that's where I'm at. But I have several of those. But this
Yeah.
is very helpful. Thank you very much.
I mean, it's the same process, and each investor is a little unique. They all follow general rules and best practices, but they might have some personal background that makes them extra comfortable stretching for your investment. And that's something, that diversity of an audience, there's the only way to get that's through volume. So if you're not casting a broad enough net, you're not getting that diversity. And that's also how you get competition and valuations. So the other reason why you go through this process is one term sheet is amazing compared to 0 term sheets. But it's nothing compared to having 2. So if nothing else, being able to attract more interested parties keeps everyone honest and make sure that you're getting the best terms. And I, again, highly encourage you not to just look at the headline number. Terms can make all the difference in the world. So it keeps it keeps everyone honest, make sure you're getting good terms at a good price. Any other questions? I'm going to put a stack of my cards up here in the front. Please, anyone feel free to reach out afterwards. We take interns all the time to do this work. I also, again, know a gazillion companies that could use this work. Try to pay it forward to Carnegie Mellon. I'm a Tepper alum myself. I've gotten so much out of the school. So thankful for everything the school's been able to do for me. And I'm very happy to pay it back. So thank you all again for attending today. Great turnout, great questions. Really appreciated the participation, and good luck out there.